Our first person to come up and talk for a couple of minutes here. It is my honor to introduce this person. So this is the senior strategist for the Tetrault Wealth Advisory Group. This person has a lifetime of experience in the industry, and in particular, investing in real assets. He started off in banking, actually, and eventually became a partner, his own, of a local brokerage firm here in Winnipeg. He led the corporate finance department, so raised billions for private and public companies, and has a real love for real assets and in particular real estate. He's also a developer, real estate developer, and just really, I cannot imagine a more perfectly suited person to talk about this subject matter today. And this person, even with 50 years of experience in the investing industry, he's still passionate about it. He still gets up first thing in the morning, looks it up, and he also just happens to be one of my favorite human beings, and that person is my dad, Claude Tetrault. Come on up.
Okay, merci. Good evening, everybody. I have nothing to say because Tanya said everything now, but just before I introduce one of our panelists, Rob asked me to say a few words about myself. Yeah, I started in this business actually 50 years and 4 days ago on November 18th, 1972, as a trainee for a small financial firm. And then literally 2 years later, I was managing the fixed income portfolio, which has been the passion of my life ever since, along with developing real estate and real estate investments. So in the process of my career, I owned my own firm. I was a partner. I've done every single function in a bank. The bank, one of Canada's largest banks, bought our firm. And so I finished my career with them as a managing director. And so I kind of retired, then I came back and worked for my son, Rob, his wealth management group, helped them. And one of the things I do, which is pertinent to tonight, is my passion for, I believe that everybody should have alternative investments in their portfolios. I believe in the asset class. There's all sorts of different investments now in that asset class, but I've always specialized in the real estate part of it. And everybody should have a slice of that. And what I do for the Tetrault Group is I do the due diligence, because in the old days only the pension funds and the institution could invest in that asset class. And it is a valuable asset class. And so now that the people on stage here in a few minutes will be describing is you know, the attributes of that asset class. And but one thing we need for the people is to add a certain degree of due diligence, and that's what I do with my experience with the Tetrault Group. Is whenever a group pitches us on their product, like these people around the hall here, we take a good look at it. We look at their plan. We look who they are. And 3/4 of them we don't do them. But once we really like something, then we meet management in person. We do on-site visits. We really take a good look at all their financial statements, and then we have several meetings with management. And then once we're convinced that management has the ability, the experience, and they can make it happen, that's when we decided to put them in our clients' portfolios, once we're sure that they can make you money with their product and without taking undue risks. So that's what we do. I'll let these people explain their products. I just want to introduce at this time a person I've known. His name is Dennis Mitchell. He's right over here on my right. And I've known Dennis for, I think I met him either 16 or 17 years ago. And when he was portfolio manager for a firm called Century. And then I've known him over the years. He later moved on to another firm. And then about 4 years ago, He started and became president and CEO of Starlight Capital. And Dennis is a very, very successful portfolio manager. We've invested with them for many, many years, and we continue to do so because he has a track record, and he's got a lot of other things which would take a long time to say. But as far as his pedigree, Dennis, I'm not going to go through all the degrees that Dennis has, but he has certain important ones. Like he's beside his degrees and his master's in business. He's a CBV, he's a CFA, and as part of his track record, most of you have probably never heard of the company called, not Lipper, but anyways, they rank, it's a senior's moment here, they rank all the portfolio managers across the world. That's all they do, is they track the performance of portfolio managers all over the world. And then they give awards, but the main award, the big award is the Top Gun Award. And if you get the Top Gun Award, that means that you are the best portfolio manager in Canada. And probably most of you don't know that, but Dennis Mitchell over here not only won the Top Gun Award once, but he's had it 3 times. Dennis Mitchell.
Okay. Well, I'm not sure if I need to say anything after that. I'm suddenly in love with the entire Tetrault family. But thank you very much, Claude. Usually I come up here and I brag about how I've been doing this for 20 years, and everyone says 20 years, but now I'm following a guy who's been doing it for 50 years, so I'll do my best to not disappoint. So as Claude said, my name is Dennis Mitchell. I have the honor of being the CEO and CIO of Starlight Capital, and we are focused on alternative investments. Specifically, our business is focused on real estate and infrastructure, which I've been managing on and on, at different shops for 20 years now. And tonight, what I want to talk to you about is our private infrastructure strategy. And before I get into it, question for all of you, show of hands. How many of you think that we will be in a recession this time next year? Hands up. Okay, so a good chunk of you. How many of you think we're in a recession right now? Good chunk of you. Don't need a show of hands, but ask yourself this. If we are in a recession now, or in a recession next year at this time, will you continue to use electricity? Probably, right? Water? Transportation? Communication? The reason I ask this is because infrastructure businesses and assets provide an essential service in a supply-constrained manner to vast swaths of the population. Could be Canada, could be the US, could be Winnipeg. Okay, but infrastructure companies provide an essential service that is necessary for the functioning of economies, cities, towns, countries. And so whether we're in recession or not, you're probably going to need gas, electricity, water, you're probably going to need high-speed internet, you're probably going to need cell tower access, data centers, and so that's the exposure we provide in the Starlight Private Global Infrastructure Pool. Okay? So I'll start by giving you an idea of some of the exposure that we have. You may have noticed that there's a war taking place in the Ukraine. And one of the things that Russia is doing is cutting off gas and oil supplies to continental Europe. And as a result, power prices have spiked across the European continent. But what's also taking place is that European countries are now beginning to understand that national security includes energy independence. Now, oil and gas assets, Saudi Arabia is blessed with a lot of them. We are blessed in this country with a lot of them. But you either have them or you don't. So most countries around the world have had a strategy of increasing their renewable energy generation internally. Why? Because you either have oil and gas or you don't. It's a little too late to start burying dinosaurs in your country and waiting for them to turn into oil, right? But you can build solar, wind, hydro in your borders and make yourself energy independent. And that is what is taking place across Europe. And I bring up that example because one of the businesses we have exposure to in our infrastructure pool develops solar assets across the world. And as you can imagine, the war in Ukraine has created a significant increase in demand for solar assets. And so these guys have been building solar assets around the world for 20 years. You know, the cost of a megawatt hour of solar energy has declined from the point where it was only viable if governments provided huge subsidies to now solar energy is actually more cost effective than the traditional fossil fuel sources. And it's renewable. I mean, the amount of solar radiation that hits the earth every year is pretty fixed and constant. So we've been investing with these guys for just over 2.5 years now, but their track record goes back over 20 years, and they've generated on average 20% returns. And a lot of people have talked about the fact that interest rates and inflation are up significantly, and that must mean the value of assets have come down. And that's largely true. But when you're developing the assets from scratch, rising interest rates means that you might not make as much money, but you're still going to make money building the asset and selling it to somebody who needs that power desperately. So that's one of our investments. Anybody have any idea how many cell phones there are in the United States? Anyone want to venture a guess? There's 340 million people in the United States and 300 million cell phones. By 2030, there will be more cell phones in the United States than people. And I think everyone here knows that in order to get a signal for a cell phone, you need a cell tower. So one of our investments is a developer and owner of cell towers across the United States. They finance 80 to 90% of the development of cell towers across the US. Okay? Sleepy little guys live in a sleepy little town of 4,000 people in Ohio. You'd never find these guys if you were looking for big-time investors in New York or London or Paris. They've been building cell towers in the US for 20 years. You know how much it costs to build a cell tower? $300,000 of steel, concrete, and fiber. And those cell towers tend to sell for between $1 million and $1.5 million. So you can see the arbitrage. It's $300,000 to build a $1.5 million cell tower. These guys have been doing this for 20 years again, and their track record is about 24% returns. So they give us exposure to yet another diversified sector with long-term strategic growth. Anyone here ever streamed a movie on Netflix or posted on Instagram? I see some grandparents out there. I know you're on Facebook, okay? All of those are called applications, right? Whether you're streaming a movie on Netflix or Disney Plus or Amazon Prime, whether you're posting to Instagram or Facebook, right? All of those are applications that are hosted on a server in a data center somewhere nondescript. It might be Virginia or Austin, it might be Vaughan, Ontario. 90% of the data that exists in the world today was created in the last 2 years. So that should give you an idea of the sheer amount of data that gets created from our smartphones, our smartwatches, from all of the media that we stream, the social media we consume, or just in our daily lives at work, right? The Zoom and Teams calls that we used to do instead of getting together like this, all of those applications hosted on servers and data centers around the world. One of our investments, you guessed it, is a company that develops data centers for Microsoft, for Amazon, for Facebook, for Google. They build them, they sell them, 20-year track record, 30% returns. So in the Starlight Private Global Infrastructure Pool, what you get exposure to are global infrastructure businesses that are providing essential services for people across the world. Could be communication, could be transportation, could be power, water distribution, you name it. And the great thing about infrastructure assets is because they provide an essential service, they're not as volatile as the economic cycle. We're still going to need power, communication, transportation, whether we're in recession or not. One of the other great attributes about infrastructure businesses is they throw off a lot of cash flow. So our infrastructure pool pays you a targeted 5% yield, and that yield is extremely tax efficient. For the last several years, it's been 100% return of capital. So it's not just the 5% yield that you're getting. We all know that it's not about how much you make, it's how much you keep. So with our distributions being at 5% and you getting to keep 100% of it after tax, that goes a long way to paying bills or funding grandchildren's educations or exotic vacations in somewhere warmer than this. Okay? So I'm going to stop there because I got 10 minutes, and I think that I kept within my 10 minutes. I'm really excited to talk to you guys about the Starlight Infrastructure Pool. I'm going to cheat a little bit and say that last year our infrastructure pool delivered a 23% total return. This year it's delivered 21%. Okay, so very uncorrelated to markets as a whole, great tax efficient yield, and you're providing essential services to big portions of the global population. So with that, I'm going to yield the mic to Tanya. Thank you very much, and I'll talk to you guys in a sec.
Thanks so much. There we go. Thanks so much, Dennis. Looking forward to hearing a little bit more about this later on. For the moment, I will now introduce you to our next panel member, next expert. So I need a cheat sheet here because this next expert has like 20 letters after his name, so I need the list. So I'd like to introduce you to David Vanka. He's going to be talking to us today about the Crescendo Music Royalties Fund. He is President and Chief Financial Officer at ICM Asset Management and Chief Executive Officer of ICM Investment Management. More importantly, he's actually the portfolio manager for the Music Royalties Fund. So any and all questions related to that, he's your guy. Now, David has 30 years of experience in investment banking, trading, capital markets. He holds designations as a chartered financial analyst, chartered professional accountant, chartered accountant, and he's also registered as a portfolio manager with the Alberta Securities Commission. He holds a bachelor's of Commerce with distinction from University of Calgary. Oh, whew, now I can take a breath after all of those credentials. Happy to have you here. Please help me extend a warm welcome to David Vanka.
Well, thank you very much, and thanks for everyone for coming tonight. And weather in Winnipeg is definitely better than I was expecting, and I was hoping to bring my Bombers jersey, but I had to hang it up, unfortunately. That was a tough one. But with respect to the theme tonight, alternative investments, our firm, ICM Asset Management, is in that line as well. We manage about $1.6 billion of assets for investors, predominantly in Canada as well as a few internationally. And our focus remains on really hard assets, real assets, where you have to roll up your sleeves to generate some return. We have a real estate portfolio, which is separate and distinct from this, and then the music royalty portfolio. To our knowledge, we're the only available fund like that in North America. And thematically, Dennis hit on a couple things which are really interesting. He talked about the growth in streaming. He talked about the growth in smartphones. And he also talked about what people do if we do have a recession or are in a recession right now. They're not running out and cutting their Apple Music subscription or their Spotify subscription or even perhaps their Netflix subscription, or we saw a little bit of that. And as an asset, I think it's new to a lot of people. It's unusual, but every one of us is sort of touched by music. We listen to it. We have it playing on our phones. We're also seeing it on our fitness apps, our Peloton, in video games, and in movies and content that's being created by the likes of Disney Plus and the others who are really building out this massive amount of data that we're seeing over the last couple of years. And what's been happening in an industry that was really in decline, 15 years ago when people were pirating CDs, using Napster to illegally copy the music. We've moved to this model now where the light switch came on for the industry, where it was like, okay, everyone has a smartphone now, and we're getting more and more data availability. So we're going to move to this streaming or consumption model where one can buy a subscription, enjoy access to all the content that's out there, and then continue to participate in that. And what that has really led to originally was some disbelief, but then ultimately adoption. And now pretty much everyone here has a music subscription or multiple music subscriptions, and the market has continued to grow as we've seen. From an investment standpoint, there's a couple characteristics of it which are really appealing. The diversification benefits is a major one. So bond markets, equity markets had a tough year. They had a tough year when COVID started and then rebounded. And those those asset classes will ebb and flow with the liquidity of the market, the economic conditions, the sentiment, corporate profits, you name it. Music, on the other hand, continues to be listened to, continues to grow, and has continued to perform through all of these market cycles. So as a diversification asset, it's a really, really interesting tool that fits people's portfolio. And the assets themselves are very long life assets, so the cash flow generated from them can last for well over 100 years in many cases. The other thing that's been happening is a number of major artists have been selling their catalogs. So this is a fairly new phenomena of any size, but we've seen the likes of everyone from Springsteen to Neil Young to smaller artists all monetize their catalogs. And this has led to a little bit of an industry where there's some acceptability for older artists to sell, and there's also acceptability for new artists who can monetize their catalog and then reinvest in their career rather than take a loan from a label. So we're excited to talk more with you guys about this tonight, and happy for any questions as we move on. So thank you, and thanks to the Tetrault team.
Thanks, David. I just hit myself in the face with the mic. Okay, all right. So we have one more guest to introduce. So I would like to introduce to you Jason Jogia. So Jason Jogia is going to talk to you today about the Avenue Living Agricultural Land Trust, so essentially farmland trust, right? Jason is the Chief Investment Officer at Avenue Living, as well as Chief Executive Officer of the Avenue Living Opportunity Trust. He's got over 15 years experience in real estate capital markets, and actually prior to Avenue Living, he led the management of a $1.5 billion real estate debt portfolio. A couple of other cool distinctions here as well. Jason serves as an instructor at the University of Calgary, specializing in real estate finance, and he holds an MBA from University of Calgary, as well as a Master of Corporate Finance from SDA. Oh, I'm going to try to pronounce this. Bocconi in Milan. How did I do? So. Okay. And also in 2020, this is a very interesting honor. In 2020, Jason was featured in Avenue Magazine's Top 40 Under 40 for his achievements in transforming what real estate investment can look like. And that's quote unquote. Super interesting, amazing. Happy to have you here. Jason, come on up. Please help me give a warm hand for Jason.
Thank you so much, and thank you for having me out tonight. Great to be out in Winnipeg, and I do agree. It's not as cold as I expected, so I'm very grateful for that. It's Bocconi, SDA Bocconi in Italy, but you were very close. So to talk about Avenue Living and talk about the Ag Fund is what I was asked to do today, and I'll start with opening up about Avenue. So we're a Calgary-owned and operated firm that is about 16 years old. We started early days focused on multifamily assets, and we were consolidating assets that most people didn't want to buy. They were the lower to medium density multifamily assets, apartment buildings that were hiding in plain sight, that tended to pass the lens of institutions and really didn't have a lot of attraction or attention to them. As time went on, we consolidated those portfolios, we built a vertically integrated operation, and we saw some very significant success. As we entered the alternative market, we saw some complementary offerings. And those offerings included our storage vehicle, our Opportunities Trust, which I serve as the CEO of, as well as our Agricultural Land Trust, which I'm going to talk about today. And the common theme about these assets is really a few different things. Number one, we typically pick these assets in markets that were not high growth or oversaturated with investment. We typically pick these real estate assets that were, B and C class in nature. And we typically pick the assets that, we could go in, optimize, increase value, and get reoccurring returns. The recipe sounds simple when you say it out loud, but when we did it over a 16-year period, starting with 24 units, we're now a $4.3 billion enterprise. and have had significant success, like I said, headquarters in the prairies. Our agricultural land fund started about 5 years ago, and really it was an interesting idea where there was significant fragmented ownership in the space. So if we think about farmland, and I know in Manitoba there's an abundance of it, and I know in Saskatchewan there's an abundance of it, and we own a lot of it, it's the breadbasket of Canada. We saw a couple of interesting nuances. Number one, farmland in Saskatchewan was trading at about a price 40% below that of Alberta and Manitoba. We couldn't understand why. When we see differential like that, we as a management team explore. And as we noticed, the farmland market in Saskatchewan was very unconsolidated. Why? Owner-operators were running the farms. There was not any foreign investment, lots of protectionist measures, and there was very little to nil institutional investment. For us, this was an opportunity. We brought in a CEO, third-generation farmer. We built a team around him, and we started to explore the market. What we quickly realized was there was a big addressable market to buy farmland and rent it back to the farmer. And why this was a good market is because there were a few things happening in that farmer's life. On one side, there was farmers who were looking to exit the business of farming with really no liquidity plan because their kids weren't going to farm anymore. And on the other side of it, there was a demand to rent farmland because there was this huge imbalance between the cost of land, the cost of equipment, the cash flow associated with farming, and the ability to grow the family farm. And what I mean by that is the old combine could do a section, a quarter section, a half section. The new combine can easily go and farm 3,000 acres, 4,000 acres with GPS and all the bells and whistles. And that combine today costs $1.5 million to $2 million, not the same price of the cost of the combine yesterday. So farmers started to realize that we don't need to own everything we operate on. Starbucks doesn't own every location they distill coffee out of. They rent them all. So why couldn't we increase the family farm or our operations, commercialize it, and expand the operation as such? And so we got into the business of buying this farmland, arbitraging the differential in pricing between Saskatchewan, Alberta, and Manitoba, focused our buyings in Saskatchewan because it was the cheapest farmland, and the business was simple: rent the farmland back to the farmer. In true Avenue Living strategy, we found ways to enhance the value of the farmland, whether that be clearing bush, adding arable acres, adding grain bins to the site, working with the farmer to try to increase the soil quality. And over the course of the last 6 years, we've had some stellar returns on that product. I think year to date, this year alone, we're at 19%. And it's a long-term capital appreciation play. And I think that what we've been able to accomplish in 6 short years is to now become one of the largest landowners in Saskatchewan for farmland with over 83,000 acres. So that is the intro to the Farm Fund. That's intro to me and intro to Avenue Living. And I look forward to talking to everybody. Thank you.
All right. Thanks, gentlemen. Thanks, Jason. So next up is going to be our panel Q&A discussion. So I'd like to introduce my business partner, my little brother, portfolio manager with Canaccord Genuity Wealth Management, Tetrault Wealth Advisory Group, Rob Tetrault.
All right, I'll try this one. She likes telling people that I'm her little brother. Like, she's so proud of that. I do want to also recognize some people in the room here that are from TWAG, Tetrault Wealth Advisory Group. There's my sister Tanya. There's Jean Moquin, a.k.a. Mox. Thank you for being here. There's my dad, Claude. In the back, I see Adam Buss, head of Wealth and Estate Planning. I see Derek Funk, head of Operations, that you guys have probably all met. I see Yvan Bourgeois on the marketing side. I also saw earlier Diego Guzman is here for sure. Ria Gupta is here as well. Karen is trying to hide. Karen, good to see you. And I also see Clint and Kevin from the Canaccord office, so really well represented here. We're like 3/4 of the room, actually. No, I'm kidding. But thank you all the team. Great to have you guys here and to support this event. I'm pumped about this. So I know they're the show. I get it. I just want to tell you one story before I get into why alternative assets mean so much to me. And some of you may have heard this story. I was doing my MBA at Asper School of Business, and I decided to study to take a look at why Canadians, retail Canadians, you guys, unfortunately, we're underperforming on a both risk-adjusted basis and on an absolute return basis. So absolute return is 10% versus 8%. Risk-adjusted basis is how much return am I getting for the risk or volatility that I'm taking. So Canadians were dramatically underperforming endowment funds and pension funds. And I said, why is this the case? Like, how come? So I studied this as my thesis, and I discovered, you guys want to know what the punchline is? I'll tell you, I'll save you 40 grand. It's alternative assets. Like, that's, 90% of the improvement in risk-adjusted returns for pension funds and endowment funds. The reason they do better than you guys is because of alternative asset classes. So I said, I'm a pretty smart kid, I said, I'm going to start a business and I'm going to bring that model to the retail investor, you guys. And I said, I'm just going to figure that out, and I'm going to also do it by providing the absolute best service that could possibly be provided. I'm going to surround myself with incredibly quality, talented people, and the only thing they're going to care about is the client comes first at all times. I'm going to focus on what I can control, which is the client service, the asset allocation, and I'll let the rest kind of fall where it may by making smart decisions that are based on good information that we're getting. But I'm not gonna lose my mind or my sanity if the markets fall 30, 35, or 40% in a year, because I know it's gonna happen. Unequivocally, I know the stock market will correct again. 3 years, 4 years, 5 years, I don't know, but it will happen. It's gonna correct 30, 35, 40%. So I said, what do I do for that? Let's add alternatives to the portfolio, and that's what we decided to do. And that's why I'm a big believer in that. That's why you guys are here today. I've talked about multifamily real estate in the past. I've talked about private real estate. I've talked about commercial, industrial, office, all sorts of real estate. Today, 3 asset classes that we're talking about. I'm going to sit down because that's it. Dennis, I almost wore those shoes today, and I thought someone's going to make fun of me, and yet here you are looking way better than I am. In a 3-piece suit with the awesome shoes. Maybe I'll start with you, Dennis. Infrastructure. So you touched on it a little bit. I do have my notes here. Tell me how, okay, so you talked about the returns. And again, this is not a pissing contest for returns here, folks. All 3 of these investment, they generate different returns for different purposes, different clients at different stages in their lives. So they're not necessarily for everyone, but they're probably definitely could be. Dennis, I want to talk to you. Answer me, if you could possibly, please answer me, how you make money for clients. You talked about kind of owning the asset, but tell me how the end client, actually my clients, actually make money. So obviously there's a distribution and there's a potential return, but how does the fund make money?
Yeah, so I mean, my job, similar to your job, is to go out and find those partners who are going to create value for us long term. And I say us because I'm one of the largest owners of any of the solutions that I come up and speak to you about. I mean, if I'm going to come and tell you that you should own it, it stands to reason I should own it too. And not only that, but my children are pretty big investors in our solutions too. So we find partners who give us exposure to sectors that have long-term structural trends. So cell towers, data centers, power generation, airports, toll roads, rail, you name it. I've been doing this for 20 years. I have a global network of people who feed me opportunities, ideas. I am members of a number of organizations around the globe that give us access to literally thousands of general partners who manage these types of strategies. And then, fortunately, Starlight Capital is a subsidiary of a much larger parent company that manages $28 billion. And so we have access to full legal teams, risk teams, compliance teams who help us do the due diligence on these investments. So really, it's a function of us surveying the market to say, where are the best opportunities? Where is money flowing? Where are returns going to be generated longer term? And then we do thorough due diligence. Claude was talking about the due diligence. It's great to have a team of people who I can bring ideas to and say, let me know if there are any politically exposed people. If there's any litigation. Are they on a sanctions list? Is there adverse media? Are there any devious principles that I have to be concerned with? And then, we've been doing due diligence for 20 years on these types of businesses. We then go through an additional process with my team, and the goal here is cash is king. You've heard that saying many times. Well, if cash is king and cash flow is divine, because any business with rising cash flow, that's what gives your business life. So the investments that we have are in industries with structural tailwinds that drive more utilization, more growth, more cash flow generation. We do the due diligence. If they pass muster, we allocate capital. And the last proof point, as you said, cash flow, right? Great businesses generate more cash than they need to fund the business. And the end result is they pay us rising distribution streams that we pass on to you, the end investor, and in this case, myself as well.
Okay, so it's cash flow, obviously, from the partnership in solar, cell towers, whatever it may be. And the total returns, the 20-odd%, how much of that was also kind of increase in the value of the asset, or is it mostly cash flow?
Yeah, I'll give you an example. So, and I'll preface it by saying this. You know, Warren Buffett is my hero, right? When I was growing up, I knew with 100% certainty I was going to play professional football for a living. 6 knee surgeries later, I manage money, right? So my heroes have shifted from Walter Payton to now Warren Buffett. But Warren Buffett famously said in 08 and 09, he said, a rising tide lifts all boats, but it's only when the tide's gone out that you see who's been swimming naked, right? So for 40 years, as interest rates have come down, that's the rising tide that has lifted all boats. So today, as interest rates go up, what you need to find are managers who are creating value. And so one of our investments was a company that bought a logistics firm and they bought a waste collection firm. They invested heavily in these businesses. They grew revenue 90% year over year, and they grew EBITDA 60% year over year. And so what do we get? Rising cash flows, rising values. And so that's what we look for in our investments. Management teams that are creating value, they have a track record of creating value, they pay us cash flow, they invest meaningfully in their own investments themselves, and they're in industries with structural tailwinds that'll allow that to be the case for many years going forward. That's the secret sauce.
Cash flow, if you didn't get it. Thank you, Dennis. David, I'm moving on to you. Major artists are selling their catalogs. I've seen the headlines. Neil Young, who else sold a catalog recently? Bob Dylan sold a catalog, and I almost rolled over in my chair. I was like, Bob Dylan. So what are you seeing? Why are you seeing these artists sell their catalog, and why do you think it's happening?
Sure. It's been a really interesting time because the music space was a space that lacked transparency for a very, very long time. 3 major players owned or collected a lot of the assets. You'd hear aging artists like David Crosby complaining he wasn't getting paid and things like that. But a number of them ended up with their rights. And then what was happening, and not so dissimilar to what Dennis mentioned about this low interest rate cycle, interest rates were very low, money was very cheap, and a lot of the large institutional investors, pensions and otherwise, are continuing to look for places to put their money, and they love the concept that the music royalties were diversifying their portfolios, which already had alternatives in it, but needed some more, or needed something that's a little bit different perhaps than their other ones. And then secondly, they saw this trend with this rise in streaming and consumption going on out there. So for the artists themselves, there's a couple things going on. One, the valuations were just coming in at prices that they hadn't seen in the past. Second condition was, like everybody else, a lot of these iconic artists have their own estate planning issues, their own considerations, and it's like, well, now I'm 70, 75, my family's a little bit different, my life's a little bit different, or perhaps I haven't been able to tour and I haven't managed my own affairs as well, so this is a great way to monetize what we're doing. So, and I think you mentioned Neil Young and others, but there's becoming, I think, more acceptability to doing that than there was historically, because you know, back in the day, owning these rights was sacred, and getting the rights back where they could was sacred. But as more and more artists kind of continued this, it set a path for everybody else. Now, the younger artists, you know, we've seen artists as, you know, people like Justin Timberlake, certainly Latin artists, electronic artists like the Chainsmokers and others sell their catalogs. And the reason some of them are doing it is less so for estate planning purposes, but they can actually go take these proceeds, one, diversify their own assets, because really it's all in one place, and that's not good for anybody, even for them. But then secondly, if they've got an ongoing career, they can take that money and reinvest in themselves. So rather than go to a major record label, which will give them an advance, which is effectively a loan that you have to pay back before you receive any money, they can say, we can create our own record label. We can reinvest in our own career and own these masters outright as we move forward.
So it's not to feed their drug problem.
Sometimes.
No. But I kind of see it like a business owner, right? Like you've built a very successful business. You're in your 70s. You want to start doing estate planning. You want to maybe sell out a portion of your business shares to key shareholders. Selling a catalog is your life's work. And I can kind of see it. I've always aspired to be a lead singer, and I never will be able to. I know that. But I do see there's one back there, Jer. And, it's your life's work. You've built this. You've accumulated. I totally get why you would want to sell a portion of that. It's like selling a business. And maybe you don't sell all of it, or maybe you do. But why should they not get to monetize their life's work?
Well, and as Jason said a little bit, even on it doesn't have the same problem where the next generation doesn't want to take over the farm, but there are future generations which have their own dynamics in these families and estates and everything else, and they've all got their own needs or objectives, and sometimes it takes the hassle off the book. And if they can partner with somebody, and this is actually quite important, if they can partner with somebody they feel that's going to treat their works properly, not sell out their names and likenesses to causes or commercials that they don't want to be in, that helps a lot. So there's a matter of trust in that space, which is really, really important.
Yeah, no, that's great. That's a great point. I'm going to move over to you, Jason. So I want to talk about inflation. So we've all seen the headlines. Inflation, call it 6.5, 7, 10, whatever you want to call it. Inflation is hitting all of us hard. Maybe talk to us a little bit about the impact of inflation on the value of farmland.
Yeah, absolutely. So, inflation is a very interesting subject, especially when you're a real asset owner. And when we think about farmland, we are the asset owner, but we're not the operator. While input costs are going up for the farmer, whether it be the fuel on the farm, whether it be the seeds and the other inputs, at the same time their revenue is going up. So for their ability to flow through that inflationary pressure onto the market is critical on not only preserving values, but being a catalyst to these above average value growth rates that we're seeing, because they're tending to get more out of inflation. And at the end of the day, that output of crop that they sell at a higher price per pound, at a higher price per barrel, whichever way you want to measure it, makes its way into the production cycle, makes its way into the consumer's hands. And if anybody's gone out and bought a loaf of bread recently, it's either gotten smaller or it's gotten more expensive, shrinkflation or inflation. So it's a value chain of cost pressures of inflation that flow right through to the end consumer. And we see that in real assets across the board.
And I think if you were to just extend that, I have some farmer clients in this room, and I vividly recall the line that I grew up in Marchand, Manitoba, not too far from La Broquerie, a lot of farmers out there, and they used to always say, la terre, ils en font plus, right? Land, like they're not making any more of it. So this is a supply-demand issue, I think, at its core, right? You have more and more population. What are we hitting now, 8 billion or something in population?
Absolutely,
and
absolutely.
They need to eat.
Yeah, and I think there's a couple of nuances there. So caloric intake is increasing, composition of food choices is increasing. So, sometimes you think about it in the Western world and you think, okay, well, maybe we're coming off of grains and we're moving more towards meat, or we're coming off of meat and we're moving more towards other foods. In emerging markets, what you're seeing is as they get more and more successful, they want to eat more meat. And as they have more caloric intake coming from meat, that requires more grain input, which requires upward pressure on the demand of the ultimate crops that we're producing. So we see that we're going to continue to have sustained demand of what we're producing in the bread basket of Canada for the foreseeable future, just based on growing population and growing caloric intake and composition.
So emerging markets, they're eating more protein. They're able to afford protein. Protein needs to eat grain. What percentage of, I have no clue what this answer is, what percentage of farmland in Canada or in the world is growing food for humans versus animals?
That's a great question. What I can say to you is that over 30% of the grain is produced in Canada for global consumption. And I would say that a lot of it makes its way into animal consumption across the board, but I couldn't tell you the exact statistic.
But either way, there's more population, there's more feed, for the protein, I guess is what we'll call it. And then there's also just the fact that less and less arable land every single year with urban sprawl, and there's farmland at the south end of the city that's no longer farmland, right? Like it's now houses. So supply demand going each lever being pulled the other way, right?
Yeah, and I think climate change also has an impact on that, where there's less and less arable land available. So it's becoming a scarcity of resource. I think the quote that you mentioned, it's Mark Twain, right? Buy land, they're not making it anymore, and it's never hold more true in the current era that we're in right now. And we are seeing that. We're seeing that, even in Saskatchewan, where the average price per acre right now is sitting somewhere between $2,000 and $2,200. And it's growing at an average clip of 8 to 10% per annum on an unlevered basis. Markets that are sitting at $4,000 or $5,000 per acre are growing at the same clip. So we're seeing continued value appreciation in farmland, just based on what you just mentioned, Rob.
Fantastic. Dennis, I'm going to move over to you, and I want to chat interest rates. So interest rates have moved a lot. You own infrastructure projects. There's debt, obviously, on there. To what impact do, I guess, short term, but more importantly, if interest rates remain higher for the long term, to what impact would that have on the infrastructure class as a whole, and specifically to you guys?
So great question. A little bit of a nuanced answer. So I'm going to go out on a limb and say there are some people in this room who have mortgages and some who don't. And the people who are really concerned about interest rates moving up are the people who have variable rate mortgages or mortgages that are renewing in the next 1 year or 2 year. But those of you who don't have a mortgage probably aren't as concerned. And those of you who have got 4 or 5 years left on your mortgage am, you're probably less concerned too. Well, the argument holds the same for businesses, right? If you don't have any debt in your capital structure, probably not too concerned about how much interest rates have gone up. So when you look at infrastructure assets, they're extremely long-lived. One of the best infrastructure assets in the world is the 407 toll road in Canada. Okay, it's a 99-year concession with 80-something years left. And so as you can imagine, the debt on that asset is extremely long, and it's amortizing, meaning when the concession expires in 80-some-odd years, and I'll know because I'll be there, when the concession expires in 80-some-odd years, there won't be any debt. And so when it moves to the next owner and they get a 30 or 40-year concession, they will lever it up with amortizing debt that'll be paid off over the life of that concession. So depending on the sector of infrastructure you're in, toll roads, airports, power generation, utilities, you will match up your debt with the term of your contract such that when your contract, your power purchase agreement, your concession, your ROA allowance, when it expires, you don't have any debt. And because they're extremely long-lived assets, you generally aren't as exposed to the cycles of interest rates going up and down. So that's part of the due diligence that we do, to make sure that the debt structure matches up, the volatility and the duration of their debt matches up with the volatility and the duration of their assets. Where there's a mismatch, there's problems. Where they're appropriately paired off, there's less problems.
You're basically making sure that you're locking in a reasonable profit when you factor in 30-year debt, 30-year concession, calculate your cash flow, you know what your income is going to be for the next 30 years. So just make sure that your debt payments are significantly less and sell it for a multiple of that spread.
Well, and I'll go you one better. You were talking about inflation. One of the great things about a lot of infrastructure assets is that their revenues are sensitive to inflation. So for instance, let's go back to the 407 toll road. You're allowed to increase the concession or the tolls on the toll road by as much as the market will bear. So we've been in a 2% inflationary environment for, give or take, the last 30 some odd years. They have increased tolls by on average 9% a year. So 2% inflation, increasing tolls by 9%. What do you think they'll increase tolls by when inflation is 7, 8, 9%, right? If you look at some of the power purchase agreements that our investments have signed to deliver power in Poland or in India or in the UK or Canada, that increases by the rate of inflation every year. And so this year in Europe, we're seeing price increases of 10, 11%, and inflation continues to climb in markets like the United Kingdom. So inflation is our ally. When interest rates are going up, it's usually a function of inflation increasing, and so more cash flow to satisfy higher debt costs, if you will. The example I usually make is, if you've got a mortgage and the rate's gone up and now you have to pay $5,000 or $10,000 more in interest expense every year, well, if you get a $20,000 increase raise at work, not only can you satisfy the increased debt cost, but you're probably better off. Well, for our businesses, as interest rates go up, inflation goes up, their revenues go up, they're actually better off. So inflation and rising interest rates are certainly manageable in our infrastructure businesses.
And inflation is on everyone's mind right now. So, and I'm glad you touched on inflation, because if you're sitting on cash, right, you're being eroded at 6%, because your dollar this year is buying $1 of food or gas or whatever, but next year it's buying 94 cents of food. So, if you're not investing into something, your opportunity cost right now is the highest it's ever been, almost in my lifetime, but it's very high, the opportunity cost to be sitting in cash. So this is why we preach, and you talked about it, like you need to be focusing on assets that have a natural inflation hedge, and all three of you have natural inflation hedges. And I'll move it to you, David. I would assume, I'm going to stay on the topic of inflation because it's very topical. I just saw Netflix increased it to I don't even know what anymore. I just know it's like a kidney and a lung, I think they want from me now. Disney Plus, my PS4 subscription for my kid, everything I feel like in that space is increasing. So I'm guessing, I shouldn't answer the question for you, I should just ask you the question. How is the music space handling inflation?
Well, it's been a relatively new area, and Netflix is trying to do whatever it can to generate subscribers. I think, at the level of, like, where does the money come from to pay us as royalty holders? It comes from subscriptions to these services. It comes from advertising revenue in certain cases, and it comes from licensing music into everything from Netflix shows to commercials to video games to everything else, and some touring revenue. So really, where inflation starts to kick in, we see these music subscriptions almost as like utility bills. So they'll gradually creep them up, they'll gradually creep it up. People keep paying them, and most families will own one or two music subscriptions, sole music subscriptions, because you can get all the content you want on any one of them. So they've got enormous pricing power, and it's going to be one of the last things that gets cut in most households. Video's a little bit different, because video is moving to this bespoke content model where if you want to watch The Mandalorian, you need to buy Disney Plus. If you want to watch Ted Lasso, you need to have Apple TV. If you want to watch, something else on Netflix, you need that. And it goes on and on and on. So most families don't even appreciate how many subscriptions they have. And this is what Netflix ran into a little bit, was they were reaching a bit of the saturation point where consumers were starting to make a choice between, maybe we'll have 4 of these instead of 16 of these in the family. But generally the pricing power has remained strong, and we expect that to continue to be the case, because they're just passing it through to the consumers. And $1 here, $1 there on Sirius or Spotify, people are willing to absorb. And even Spotify last quarter had 7 million net new premium subscribers. So clearly inflation's not eating into them yet.
I don't think you can cut your music subscription. Like, I just don't think. You're going to have one less Starbucks before you're going to cut your music subscription.
Yeah, or your kids will kill you. So,
speaking of subscriptions, I did the count the other day in my house, and it was like, so Sportsnet and TSN and DAZN and Netflix and Disney and Crave and what's the other one there? Prime and the YouTube Music and the Amazon Music and the Spotify, and it adds up, and I know I'm missing some, but the PS4 subscription that my son has to have, that I keep telling him I'm going to take it out of his allowance, but I never do. Yes, they add up. Jason, I want to talk to you about the model that you guys have chosen, which is to not actually operate the farms, right? So farmers have told me in the past, why would you want to own a farm? You can't make money running a farm. So I'm guessing that you guys, I shouldn't guess, I should let you answer the question. Why have you guys chosen that model?
Yeah, that's a great question. So let's think about it. So like any other business, consolidation improves your economies of scale and economies of scope. And, you know, as I said earlier, if Starbucks had to own every coffee shop it served coffee out of, we'd have a lot less Starbucks today, because that's very capital intensive. And what we recognized in the farming industry is across the globe, there are bigger and bigger commercial operators. Commercial operators don't necessarily own every single acre of farmland that they farm. The equipment that's been built to suit those commercial operators has become more scalable. And farmers are now left with a bit of a why in the road, whether it's buy the additional acreage or buy the better equipment. I mean, some farmers can do both, and that's great. But what we've seen is that there's this opportunity for us to participate, to allow the farmer to scale up their operation should they choose to, rent the farmland at a very reasonable price, which, you know, currently present day sitting at about a 4% yield per acre on value, and be able to then commercialize or scale their operation, which then allows them to have more profitability coming out of it, because, you know, what would have been a section farmer is now doing multiple sections. And what allows them to continue to build into investing in the farm, in better equipment and better inputs, increases and enhances productivity. And then at the end of the day, the live feedback that we're getting, and, you know, we've been in this business now for approaching 6 years, and I think the quantum right now is probably north of 50, 60 different farms that we would have operating right now. Gabe's nodding at me. We've had great resounding feedback. We've only had one failed crop in our 6-year history. It was an organic crop. But by and by, the farmers have spoken in Saskatchewan, and they really do like what Avenue has been able to accomplish for them in terms of scaling their business.
So they get capital. They use some of that capital to do their estate planning or whatever it may be, and they go use some of that capital to expand the farming operation, generate economies of scale, buy another combine if they need it or whatever, farm more land. And then your model, you talked about earlier, and I just want to touch on it. You talked about enhancing the value of the farmland, building storage bins, whatever it may be. There are farmers here that I'm guessing are 3rd, 4th, 5th generation, and maybe they've just done something the same way since forever. You guys have the benefit of working with 60 or more farmers, and you see what works and doesn't work, and I guess you could bring new solutions to them.
Yeah, absolutely. So I think you know, a couple of different things. If we bring the capital, the know-how, the idea of doing something and work with them, what we notice is that there's this propensity to kind of partner up together to increase productivity. And if that means clearing bush, taking down some trees, draining sloughs, just increasing the productivity in the arable acres, or, you know, if you've got your combine that's doing patterns and you've got something right in the middle of it, or a big slew of trees, like, we will provide the capital. We might even hire the trades, but we will get that dealt with for you to make your operation smoother, more effective. And that's kind of that partnership that we forge with the farmer.
And the idea is a roughly 4% cash. Now, I know that's not being generated in Manitoba, 4% cash on some of the land. So you're getting basically, so on whatever 10,000 acre, you'd be getting 400 a year on an acre, something like that.
Yeah, so I'd say right now on a per acre basis, you're getting about $80 to $100 per acre right now. So on 10,000 acres, you'd be doing, you know, somewhere to the tune of. Yeah.
There's leverage, right? Okay. So they borrow some of the funds, and it's not the entire component that's equity. So on maybe a 10,000 acre, how much is the leverage? Is there?
Yeah, we're target leverage about 50 to 60%.
Yeah. So it's about half. So the percentages are quite a bit higher. Okay, well, that's very interesting. I'm going to ask all of you this question, and Dennis, I'm going to start with you, and the other ones can think about their answer. How do we make sure how do you evaluate the assets, and how do you make sure that those numbers are accurate?
Well, you know, Claude opened up by talking about due diligence, and I talked a little bit about our process, but it begins with the due diligence. So, you know, many of you may have heard of FTX, the crypto empire that Sam Bankman-Fried created that's collapsed in rapid order. When you peel back the curtain, what you find is that this is an unregulated business in an offshore jurisdiction that is privately owned and has no board and no chief financial officer. So you got to ask yourself, who's doing the due diligence there that these guys raise billions of dollars of other people's money? So it starts with the due diligence. You know, you weed out players like that. So our diligence begins with our risk, compliance, and legal teams, vetting them. We make sure that who we're partnering with, they're legitimate. We go and see them. They fill out our DDQ. We go through their data room. We test their assets. We test their investment process to make sure it's repeatable. My business partner, Graham, does the operational due diligence. Who are your business partners? What's your custodian relationship? So on and so forth. We present to the investment committee. You know, it gets approved. We make the allocation. Part of our due diligence on the operational and investment side is saying, who is your third-party external valuation agent? Who tells us how much cash flow you're generating? Who audits it? Who gives the actual valuation? It has to be an external third party that is arm's length. If it's not, you fail our due diligence, we don't partner with you. We were looking for, on the real estate side, a life sciences partner. Life sciences real estate is a fantastic long-term investment. It looks like office, but it's really lab and testing space and research space. Your tenants are companies like AstraZeneca, Pfizer, Moderna, the guys who created vaccines for COVID-19. It's a wonderful business. We found a great fund and great partners. When we completed our due diligence, we discovered that despite the fact that they had different last names, the CEO and the COO were actually husband and wife, and the president of the operating business was their son. There are no checks and balances there. There's no internal controls when you're dealing with blood immediate family relations. We said thank you very much, and we passed. Very large Canadian pension plan had given them $750 million. They passed their due diligence, they didn't pass ours, right? And the last thing I'll say is it comes down to this. I am personally invested in every solution that I create. And so from my viewpoint, I get paid every day to come into work and manage my own money, and all of you come along for the ride. And so when it's your money, it's one thing to come here once a year and maybe apologize and tell you a wonderful story. It's another thing to make sure that my check to my ex-wife doesn't bounce, okay? So it's my money that's on the line right next to yours. I care. We have a thorough due diligence process, and it includes ensuring arm's length third-party valuation agents.
Perfect. Third party arm's length. David, how do you make sure that the catalog you bought a year ago for $1 million and today you're saying it's 1.05 million? How do we know that that's an accurate number?
Sure, we'll touch on a couple things there. I'll touch on the due diligence as well, because I think that's important in this asset class, because unlike infrastructure or real estate, you're investing in copyrights. You can't go touch the dirt, so to speak. It's all in the ether and reliant on copyright laws. With respect to valuation of these assets, the nice thing about them is once you own them, you don't have any incremental expenses. You know, unlike real estate, you won't have capital overruns, delays. You start getting paid usually within 3 months of acquiring these assets. So when we're evaluating opportunities, we look obviously at what the assets have been doing, how much cash has it been generating recently and historically. That's one consideration. How old these catalogs are is another consideration as well. So something that's 20 years old or 30 years old is much more stable, has a much longer history than, say, a catalog that might be 3 years old, which maybe had a lot of radio play, a big hit or two, and then that radio play is falling off and it materially changes it. So we're trying to find assets that have reached a bit of a stabilized point of revenue generation, and it usually means that streaming is a bigger component of the assets than perhaps radio play or licensing into movies and the like, because that can be fairly lumpy revenue. And with that, then we look at sort of optimistic cases, base cases, and pessimistic cases based on how these cash flows are coming in. And in addition to just thinking about how old it is, what the genre is, what the revenue's been, we look at other factors. Are these artists collaborating with other artists? There's huge implications of that. Are they going on tour? You know, we own rights to some of Taylor Swift's first 5 albums. Well, Taylor Swift just broke the internet again and broke Ticketmaster and everything else. And it is good because anytime there's eyes on the new stuff, eyes go to the old stuff as well. And yeah, it benefits our catalog even though it's the older material. So all those things help. What's happening with social media with these artists? Are they trending up? Are they trending down? So all those things we kind of factor into our decision process. And then once we acquire the asset a year ago, we're able to monitor the cash flows that are coming in and seeing how consistent they are with our underwriting assumptions, whether we make changes or tweaks or things we can do over time. And they generally tend to be gradual valuation changes because these are very long life assets like infrastructure. So, you know, the results of a quarter or two don't necessarily mean there should be a dramatic change in the asset, but the trends are telling for sure. And then on the due diligence side, I think it is important here when we acquire an asset, we have to go through an entire legal due diligence and from the cash that's been coming in, we can check it. You know, typically it comes up from some version of Universal, Sony, or Warner, and then some of these collection agencies. So people who are songwriters would have heard of SOCAN in Canada as an example. Those can be areas that are paying us, and we can go back and check and validate that those revenues have actually come in historically. And then on the legal side, we get considerable reps and warranties that the artist can sell what they're selling. We do things like lien searches to make sure we're not buying off someone who owns something to the IRS, just things of those nature, and then sort of button the asset down that way. So that's where it goes through. So a lot of the due diligence side of it, the financial side's probably actually the easier side, and then the legal side's probably the more important side because there isn't a single central registry where you can just go to the title office and say who owns this thing. So you have to make sure that people aren't coming out of the woodwork and laying claim to the assets.
And that's why this would be almost impossible for someone who doesn't have this background to do, right? This is why you're one of the only ones in North America that's doing this.
It is difficult to do, and the other side of it is so we've done about 16 acquisitions from different artists to date. Every one is different. Every purchase and sale is different. And the artist, again, they're selling their life's work, their baby, so to speak. So, you know, on our real estate side, we see 17 different transactions. They're all done the same way in the same neighborhood. Everyone knows what they're doing and are plugged in. It's not necessarily like that in the music space. You get high variability in terms of the sophistication of the seller and their passion about what they actually own. So,
thank you. Jason, same question for you. How do you make sure that the farmland is actually worth what you say it is?
Yeah, that's a great question. So I think the academic in me is just going to go conceptual for a second. When we think about valuation, and akin to what the gentlemen are saying, you're looking forward to bring it back to today. So you're not looking in the rear view mirror. You might be looking at it in trend basis, but you're trying to project the forward outcome and then seeing what that's worth today through mechanisms. And so forward outcome would price in the risk that's associated with the market right now, whether that be interest rates, inflation, or anything else that's happening in a certain period of time. So when we look at that, management has kind of a four-pronged strategy. One is we have our internal management valuation model, excuse me. Sorry.
Net present value and discount value of cash flow.
We've got an internal valuation model that we use, that we maintain month to month, every month with new inputs. Our second layer is third-party appraisals from accredited appraisers, whether it be local or national firms. They all have the same accreditation, and we use a bunch of them. I think the third layer of due diligence on valuation is our lenders. When we borrow against our assets, our lenders are always looking at those assets. When you go get a mortgage for your home, you may tell the lender it's worth twice the amount that you think it is, but they're going to be sure that it's worth what it's actually worth. And I think the final piece of that is our auditor. So we use EY as our auditor. There's big 3, big 4 in Canada, and they're international. And every single year, EY will run a process testing management's methodology on valuation, testing the appraisals, testing the data that we've coalesced to ensure that what we state as our value is truly our value. So we tend to be very disciplined in this approach and have this 4-pronged strategy to ensure that our values are our values.
And that's all very, very important to us. So thank you for sharing that, guys. Dennis, and all of you actually, you've all had positive returns this year in a year where the RBC Balanced Fund is down 14% year to date. And, the bond portfolio, XBB, is down, I believe, 11. And, the Dow and the NASDAQ and the S&P are down double digits all the way up to 25%. Positive returns in a year with that, and long-term returns of double digits. So that is impressive. So congrats to all 3 of you for doing that. And it's one of the reasons, I'm getting to my question, but it's one of the reasons that we own this. It's uncorrelated, and what does uncorrelated means? It doesn't move in unison with another asset class. So stocks move up, stocks move down, stocks have daily valuation. You guys answered how your funds are measured typically on a monthly or quarterly basis. Dennis, I want to ask you a question that a client asked me the other day. If Dennis is so bullish on infrastructure, if he loves infrastructure so much, or if Rob, if you think infrastructure is such a great asset class, why wouldn't you just go and buy publicly traded infrastructure companies instead of putting me in Starlight Infrastructure Fund? If infrastructure is the future and it's going to do well, why would I just own a publicly traded stock like Brookfield Infrastructure or one of the other infrastructure plays that does data centers or whatever?
Right. So 2 answers to that. The first is a lot of it depends on the investor that you're speaking with. If there are short-term liquidity needs, like if this is money that you're going to need within 4 or 5 years, then our publicly traded solutions probably make a lot of sense for you because they're more liquid. If this is money that you're not going to need for 5, 10 years, then our pools make a lot of sense because they're slightly less liquid, but they give you exposure to the same overall assets, the same long-term structural drivers, the same geographic diversification, and over long periods of time, the same uncorrelated returns. So the first answer is that it really depends on your needs, your investment horizon. But speaking specifically about our private infrastructure solution and why it makes sense now, because publicly traded securities have sold off significantly, why it makes sense now. Again, if you want exposure to the pure asset and you don't want to deal with Joe who's got to sell all of his Brookfield because he's got to make a payment on his tractor, his house, his divorce settlement, what have you. People sell for lots of reasons, right? Some of them are relevant on an economic basis. Some of them are not. And the public markets reflect that. On any one given day, there are more people selling, and so markets go down. On any one given day, more people are buying, and so markets rise. But if you want exposure to the pure long-term asset, then our private pools make a lot of sense. Assets don't care if they're publicly traded or privately owned. They do what they do, right? They just don't care. And so it really comes down to your investment horizon and your tolerance for volatility. But at the end of the day, if you own power generating assets, payment processing assets, high-speed internet accessing assets, they're going to do what they do, and it's a function of how you want to get those returns over what time period. But we think it makes a lot of sense for our private assets right now because, again, they continue to grow cash flow. And yes, I'm going to say that all day long. Cash is king, but cash flow is divine because it gives your business life. Any business that doesn't generate strong, recurring, rising cash flow is just a collection of liquidating assets. You need that, and it's hard to fake cash flow. One of our due diligence screens, do you generate positive operating cash flow so that you can pay us consistent distributions? It's hard to fake that, right? So again, I think there's an excellent opportunity in our private pools that'll give you diversified, uncorrelated exposure to global long-term structural trends that will drive long-term appreciation. And it's, one of the reasons I asked about the recession question at the start is because I think a lot of you are going to continue to consume electricity, water, travel, data storage, you name it, whether we're in recession or not. And that, again, makes infrastructure extremely attractive for the next several years.
Very Buffett-esque, I would say, in your description there. In fact, if I close my eyes there for a sec, I could hear my dad talking to me about owning quality assets. Dave, I'm going to ask you about the music industry and how it's changed over the last years. I never bought a record, but I know that my dad bought, like, what was before records, whatever it was, and then 8-tracks, and then cassettes, and CDs, I guess, and there would have been other stuff, I'm sure, but I know he's talked to me about his 8-track player in the past. But what's changed in the music industry, and where are we going?
Well, I don't suspect 8-tracks are making a comeback, but vinyl certainly has, and even though it's a small part of the market, it's seen a lot of growth. The industry's changed a ton. I mean, it's almost been like the Industrial Revolution. You know, if we go back to when the piracy was happening in Napster and where we are today, and it's not just the music industry, but there's been sort of tectonic changes in the landscape, and even as streaming has become certainly more established, definitely in North America, it's still early days in emerging markets and even some of the developed countries which have been slower to shift. So there's definitely, we're seeing a lot of growth in these other markets, which is why, firms like ours and others who research the space are very, very bullish about it. But the other thing that's happening almost at a weekly pace is there's new platforms and new revenue generation opportunities for catalogs. So what used to be, we get money from Spotify and Apple and Amazon Music in Slovakia and Amazon Music in Colombia or wherever the case may be, we're now starting to see this entire evolution of entertainment assets where we're seeing consumers go to and ultimately music go to, and the video growth side has been huge. We talked about Disney Plus, Netflix, obviously, and others in the space, but we've seen it on the video game side with things like Roblox, Fortnite, Twitch, all having to license the music. Fitness has been an emerging trend as well, and Peloton's the best example of that in terms of them needing to license their music. And much more recently, this user-generated content phenomena with short videos as best evidenced by TikTok. And probably a lot of people in the room haven't downloaded TikTok, but their kids or grandkids have. And it's now become the #1 discovery source for music in the world. So where people used to go to Spotify and before that to their records or 8-tracks or whatever the case may be, or the radio, they're now using TikTok as the starter. Also creating their own content with the same songs and then going to Spotify or elsewhere. So it's opened up an entire new audience for older music from newer listeners and newer consumers. And similarly, it's refreshed music or brought new music to everybody else. So you're not restricted to just whatever's on the top 40 playlist. So those trends continue to grow, which we like from the asset class perspective. And the last thing we're starting to see is this virtual and metaverse concept, which gets talked about a lot. But there are real artists doing concerts virtually of huge size and scale now. It started out with Travis Scott in Fortnite, and there was something like 20 million people watching it live when it came out. Bands like BTS in Korea and others are doing these virtual events that are getting like huge audiences worldwide. And even something as sort of old as ABBA. I mean, ABBA hasn't toured in 40 years, and the owners of those rights went ahead and they actually built a custom-built arena and hired Industrial Light and Magic, which is George Lucas's Star Wars company, to create a virtual, I hate to call it hologram show because it's apparently much, much better than that, but this huge event where people will go and they have sold out shows every night watching sort of a virtual concert. So that's where things seem to be going, and I don't even think we can predict the other avenues that we're going to be consuming content on as moving forward.
Who needs the artists, I guess? No, they have to create the content, obviously. Jason, I want to ask you about these farmers. How do you find them? And like I'm 16 acquisitions over here. You guys have acquired like how many farms again?
I think we've got about 60 operating farms right now.
Yeah.
83,000 acres.
How do you find these farmers, and what's the motivator for them to sell?
Yeah, I think it's twofold. I think it's either, we see two types of transactions. We see the sale leaseback transaction where they're looking for liquidity, probably to invest in the farm, probably to do some generational wealth transference, or maybe they're on the way to retirement, but they're not quite ready yet, but now's the time to exit because there's a suitable buyer. I think the other one that we're seeing is the person that's just exiting the business and in very farmer fashion would never sell to their neighbor. So they want an intermediary and they want to be able to sell it to them and be able to us to operate it or to rent it out. And in terms of soliciting these deals, I mean, there's a very, very active market out there right now for buying farmland. I mean, Saskatchewan's got 63 million acres of land and about 40 million of it is farmland or designated farmland. There's active listings on market, off market. As mentioned, our CEO, second generation farmer, owns his own family farm just outside of Calgary. And he has his ear to the ground through a network to be able to go out there. I mean, one of our special advisors to our firm is the former premier of Saskatchewan, Brad Wall. Avenue Living has over $800 million invested in Saskatchewan. So we have deep roots there. That opens up the aspect for us to find these transactions. And when we're finding them, our pretense is, again, we're not buying it as an owner-operator. So if it's somebody looking to just exit, here we are, we will exit you. But before we actually close on the purchase, we want to make sure we're matching it with the inbound customer, the renter. And that renter may be the neighbor, all on the up and ups, but we want to make sure that we're not buying something, not having the cash flow, not having the operator. And it's not hard to find somebody to extend their farm to operate. I mean, when you go and give them the math on, in our early days, we were renting at $40 an acre. Today at $80 an acre, there's significant demand. So.
They might have 40 million acres, but they don't have a hockey team. And Jim, come on. Thank you for that. Dennis, actually all three of you, I want to give you an opportunity to talk about some of the other, so I'm a big believer in alternative asset classes. You guys have heard me say this. Back in the day, I talk like I'm 1,000 years old, but back in the day, the only way you could get exposure to alternative asset classes was multifamily real estate. That was the only way to do it. It was largely through limited partnerships, bit of a complicated structure, very little liquidity. You couldn't get in and get out. You couldn't sell. It was complicated. Nowadays, we're lucky to have exposure to private real estate, storage as an asset class, storage real estate as an asset class, farmland, private equity, music royalties, private infrastructure. I'm certainly missing a few, and so someday, hopefully, like a hockey card fund, where you just buy and sit on Wayne Gretzky rookies and LeBron James rookies and Sidney Crosby rookie cards, and you hunt the market for some high quality graded cards and you put them in a fund and you sell that. I don't know. It could happen. It could happen. Dennis, maybe talk to us about some of the other alternative asset classes because I believe in all these asset classes, and all of these three here have other alternative investment assets. Maybe talk about either private equity or real estate. David, you could talk about real estate. You could talk about storage, perhaps, if that's all right.
So I also have an MBA. So I also knew that retail investors were underallocated to alternative assets. And so when we built Starlight Capital, we intentionally built it to provide institutional quality alternative assets to you. So our business is 3 verticals: real estate, infrastructure, equities. And then we do it in 2 manners: public real estate, public infrastructure, public equities; private real estate, private infrastructure, private equity. And so the idea is, depending on what your investment time horizon is, what your liquidity needs are, you can partner with us in the alternative space in either public real estate, private real estate, and you get it. So on the private side, we have our private real estate pool, our private infrastructure pool, and our private equity pool. And the idea is, Canadian pension plans are now 38% alternative assets, right? 23% of that is private equity alone. And the challenge is that most of those firms, when you hear about Blackstone managing $900 billion, and raising a $20 billion fund. Most of you don't have access to that. We give you access to that. So you're investing right alongside Blackstone, RBC, Fidelity, AXA, Hoop, OP Trust. We now give you that exposure in our private pools, whether you want to invest in real estate, infrastructure, or private equity. And again, the risk-adjusted returns, the gap between what large institutions, pension plans have been able to generate and what retail investors have been able to generate, we're bridging that gap by giving you the exposure to the same institutional quality alternative assets. And we do it on a global basis with best-in-class partners. And last thing I'll continue to repeat, we are some of the largest investors in these solutions ourselves. We think it's only fair if they were to come here out to Winnipeg after beating you in the Grey Cup and we're going to tell you to invest in these solutions, then we should invest in them ourselves. It's the least that we can do, right?
Okay, Dennis. All right. That's enough. Do they trade at the same multiple? So to clarify a few things here, private means not publicly traded on an exchange. So you can't put a share of the Starlight Infrastructure Fund on the Toronto Stock Exchange and see what you get for it. You redeem it, and you redeem it at its fair market value every single month, and you get that month's price. It's typically a multiple of the assets. Stocks, whether it's the same asset class infrastructure, they sell on a day-to-day basis on the Toronto Stock Exchange or on the New York Stock Exchange or any exchange, and they trade on a multiple of cash flow. Do they trade, are they comparable? Forget about market corrections. Historically, normally, do public equities trade at a premium or a discount to private equity? So in other words, are you able to buy cheaper assets in the private space?
Yeah, so the short answer is it depends. So let's get back into Warren Buffett. Warren Buffett used to famously talk about Mr. Market. And Mr. Market is your partner in a business. And sometimes Mr. Market can only see blue skies and unicorns and rainbows. And so on those days, Mr. Market wants to buy you out of your shares at an extremely high price, right? And then some days Mr. Market is depressed and can only see doom and gloom. And so Mr. Market offers to sell you his stake in your business at a discounted price. So, right now, everyone's concerned that central banks are going to keep hiking interest rates until something breaks. And inflation is really high and proving to be persistent. And so as a result, public equities have sold off. And so the question then becomes, well, who's right? Private transactions that are taking place at decent valuations or the public markets that are selling at deep discounts? Again, I come back to the assets themselves don't care whether they're publicly traded or privately held. They are going to do the same thing that they do. So from our standpoint, we like the private solutions because they do give you pure access to the assets that you're getting exposure to. Sometimes public markets will trade at very, very depressed valuations. So you think of March 2009, when nobody wanted, public equities were broken, right? Capitalism was coming to an end. Companies like McDonald's were struggling in the repo market to make payroll because public debt markets were so fractured and broken. At times like that, publicly traded equities are trading at massive discounts, and you have a generational opportunity to compound wealth at enormous rates of return, because we're all Warren Buffett. Problem is that most people are scared out of their minds at those time periods and don't put the money to work in the markets. So one of the great things about private assets is that they don't reflect sentiment like that. And so it makes it easier for people to take long-term strategic allocations and stay the course. And as an advisor, that is the key to making returns over the long term that allow you to retire with the standard of living that you want, pay for your children's education, go on that vacation, right? So it's time in the market, not timing the market. And I come back to the private solutions we offer give you that ability to get the pure exposure without some of the crazy volatility and sentiment-driven fluctuations that we see in public equity markets.
That's a fantastic description, and I think it's one of the reasons that we've been lucky to win awards at the national level. I recently won the Portfolio Management Award, and I was named top portfolio manager a few years back. And I'm bright. I pick great stocks, and I do really, really good at that. And our team does really, really good at that. But we own an asset class. We own some of these three asset classes, and when the markets are puking and they're down 30%, these asset classes aren't puking and aren't down 30%. So that's a great answer, Dennis, and thank you for sharing that. And it's one of the core reasons why I believe in it. Aside from great absolute overall returns, you guys all three touched on them, and phenomenal tax efficiency. And if I don't get the chance to explain this to you today, send me a note and I'll be happy to talk to you about why return of capital investing and deferred capital gain investing, as the accountant over here is shaking his head, those are the best investments tax-wise in a non-registered or a corporate account. So if you have a non-registered or a corporate account, dividends are good, return of capital better, and deferred cap gains, those two are ideal. David, same question for you. You want to talk a little bit about your either your private real estate and some of the other stuff you guys do?
Sure. And we sort of have the same philosophy as Starlight Avenue and others, in that we're big believers in the alternative space, and even talked about the Canadian pensions. I mean, even starting earlier with groups like Yale Endowment, which invented the model in some ways, and at some times has been as close to 75% in various alternative investments, and there's been good reasons to do that, and it's been very hard for most investors to access. So it's great to be able to democratize that a little bit. In addition to the music royalties, the core fund of our firm has been in real estate. So we've been in business since 2003. We want a diversified real estate investment trust, which invest in across North America and across different asset classes. So the idea is we're not captive to a certain thematic. We don't have to buy Toronto multifamily housing as an example, or we don't have to buy office buildings, but we can sort of pivot as we start to see different trends and adjust the asset allocation internally in that. So currently the fund it's probably about 60% US, with a focus on industrial and multifamily being the second choice. We still do have some offices in there, one really good one, a couple that we've been kind of shifting away from. We've got about a 20% allocation in Mexico, where we've got pretty major industrial projects in Guadalajara. Also in Mexico City, we have multifamily industrial, and we're starting to enter the hospitality space there, building a couple of Marriott hotels. And fortunately, we had no hospitality and pretty much no retail going into the pandemic. And Canadian is concentrated on, I'd call it special situations, some apartment buildings, some industrial, and looking at some hospitality opportunities in Canada. But generally the focus of new money is industrial, and call it Sunbelt US. Think of Phoenix, think of Dallas. Atlanta's a big hub for us, and a couple of projects in California.
Thanks, David. What I like about all three of your funds or the investment models is that, I'm pretty sure I'm right on this, there's never been a halt in distribution in any of your investment models. There's never been kind of a negative quarter or half year ever in your investments solutions. And there's never been a year where it wasn't, I don't know, at least 5-6% returns for all three of you. So an off year, you're still getting your distribution, extremely tax efficient, and to me that speaks just phenomenal volume. And what happens in most years, the NAV slowly ticks up. The NAV, meaning the net asset value of the shares, the share value, slowly ticks up quarter after quarter. My dad used to say, it's like watching grass grow, right? If you stare at it, you're not going to see it grow. But if you just come back and you're like, wow, the grass grew. And this is how I've felt with all three of you. Jason, last topic here. You want to touch on perhaps the storage? Or your firm generally in the storage fund?
Yeah, absolutely. So, Avenue was routed in multifamily as its first alternative fund, its first alternative asset class. And over the years, we recognized some tenets to our business. One was that, we like to play where other people weren't looking. So we focused on markets that weren't. Thank you. Oh, I got it. Okay, thanks. Yeah. So we found these fragmented markets. We found these fragmented asset types. We found that these assets had yet to be optimized, and we could bring proprietary operations to these assets to really get the reoccurring cash flow stream and grow that cash flow stream. And the storage business excited us because there was a huge demand for it in North America, quite undersupplied. We started this right before the pandemic, actually bought our first asset in February of 2020. And going through the pandemic, slowly but surely, have consolidated to become the 20th largest operator in North America. So the fund is now over 150 stores. We're about 50% of our assets in the US, 50% in Canada. And we have this kind of strategy where we buy an asset. So think about a storage building. I mean, they're not sexy. You saw them in the video. You drive by them every day. A storage like that ran by an independent owner operator would have somewhere between 2 to 3 full-time equivalent employees. Through the Internet of Things, through prop tech, we buy these assets, we add capital expenditure, branding, signage, 24-hour access, cameras, digital locking systems or different types of locking systems to get access, and we're able to operate them with less than 1 full-time equivalent. So if you can reduce the human capital associated with operating it, then you plug it into a dynamic pricing model. So believe it or not, if you went to Mini Mall Storage's website today, you could actually rent a storage locker, and on your checkout, you could upgrade a storage locker. You could upgrade. And that allows us to optimize our revenue stream to be able to enhance the pricing, the occupancy, et cetera. So these are the operating tenets of the business, the addressable market, where we play, what we do to it, why we buy it. And here's the biggest part that we really like, and it is the arbitrage between the publics and the privates. And what I mean by that is, being a private company, we buy the value that the vendor wants to sell it to us at. So if I simply think in a multiple, we might buy an asset at 15 times future cash flows. So that might be the multiple. If we look at that same stock, that same company stock on the publicly traded markets, and even now after the markets have been pounded for 3 quarters in a row, those publicly traded companies are selling at 25 times cash flow, maybe 30, maybe 35. Even in the height of when things were really frothy, maybe they were closer to 40 times. So for us, storage has become this unicorn where we're consolidating, building a strong business. You know, we'll be over $1 billion in assets here very shortly, 20th largest operator. We're continuing to see opportunity to consolidate and become this brand and this operator. And at some point, this fund may have an opportunity to create an exit and arb the public market disparity that exists today for this particular asset class.
Awesome. Okay, so on your table, every one of you, there's a little QR code. You pull out your phone. I got 5 pairs of Jets tickets I'm going to give out. So these are for reviews. So put whatever you want on it. Tomorrow morning, Mox is going to come into my office. He's going to say, we got 19 reviews. We're going to pick 5 of those. They're going to get a pair of Jets tickets. So this is it's a review. I think it's through a website, Google review or something like that. So if you do that, your name's in the draw, and I'll tell you what, there won't be that many that'll do it. So you have really, really good chances of winning Jets tickets for those of you that fill it out. They're good seats. Second of all, Beatles, Back to the Future. Those of you that are clients, if you haven't RSVP'd yet, we were practicing at the office today for our skit. So that's really going to happen. Those of you that come every year to the celebrations event, tell you what, I'm the lead actor in the skit. It's pretty good. No, it's not, but it's a skit. Third of all, and when is that? December 8th? 6th. December 6th at Celebrations Dinner Theater. If you're not a client and you want to go to that, you know what you have to do to get in, right? Run with Rob is the last thing I want to talk to you guys about. Run with Rob is a charitable event that is, it's new, it's going to be unreal, it's coming. Those of you may have noticed or heard that I started running, and I'm taking it quite seriously. I jog every morning. I do a lot of Ironman training as well. I'm going to run across the province of Manitoba. I'm going to do 12 marathons in 12 days, and I'm doing it in the month of May, and I'm doing it to raise awareness for CMV research, congenital cytomegalovirus research. It's a charity that I started when my son was born with the condition. Status quo is unacceptable. Kids are not being screened right now in Manitoba, and yet they're being screened on the other side of the border in the Grey Cup winning province of Ontario, and they're being screened on the other side of the border in the non-Grey Cup winning province of Saskatchewan. And it's absurd and ridiculous that it's not happening in Manitoba. I have a bill in front of the legislature, and I'm going to run across Manitoba to raise awareness. Thank you, Dennis, and David, and Jason, and all of you. So I'm actually going to, it's called Run with Rob, because I'm going to ask you guys, those of you that want to commit to running one half marathon with me out of those 24 half marathons. And you're going to go online on the website, you're going to register. We're going to have a motor home that day, and it's going to be very Terry Fox-esque. We're going to have a crew, support crew. We're going to have fun. We're going to make this a real event. It's going to be something like you've never experienced before. So if you have any inkling in running a half marathon in May, it gives you lots of time to train, lots of time. Runwithrob.com. Keep an eye out for the email. And I'm also going to be looking for sponsor dollars for that, gentlemen. Runwithrob.com is coming in May. So I talked about celebrations. I talked about Beatles, Back to the Future, Run with Rob. We don't have time for questions today. I do want to respect everyone's time. I promised I'd get you out by 9. I'm going to stay around for a bit. The bar is still open. I just want to remind you guys how thankful we are, those of you that are clients, that you are clients. This year has been not a great year in terms of absolute returns, but a phenomenal year for risk-adjusted returns. And, you know, we're beating our benchmarks by 10 to 15%, depending on which benchmark it is. And we're doing it largely because of your help. So I want to thank these gentlemen. I want to thank you guys for being clients. Oh, and Diggs, am I giving away prizes? I forget. Well, and you get a car, and you get a... No, we do have some swag that we'll give to you guys at the Celebrations Dinner Theater that these 3 gentlemen provided. So we'll save those for the Christmas party. Thank you, guys. And that's it for the evening. We're going to stick around for a bit. Have a great night, and we'll see you in the funny pages, I guess.